morning. I have already explained six modules. Sixth module is divided into different components because it's a lengthy chapter, computation of salary income. So sixth module, the first module I have explained what is salary, the features of salary, what all are included in salary, what is the definition of salary. So that is completed one component. Now the second component we are coming, that is the Provident Fund computation. See, we have to use Provident Fund computation for our income tax calculation. So that is what I am going to explain with module 6.1, where I will explain about the Provident Fund computation. So this is important because when we are doing the problems also, some 2-3 points I will tell you which will be very important for your income from salary computation. So this module I am going to explain. I am also using PowerPoint presentation, and I have covered it as a tabular form because sometimes you will get the theory question. Explain about the types of Provident Fund. So then you have to remember that this you have to learn in detail for a theory question and some points which will be relevant for computing the income from salary that I will specify, and I will repeat that again and again so that you will register in your mind. So I am going to do that with the PowerPoint explanation. Provident Fund computation. So Provident Fund computation, you have to remember. See, there are four types of Provident Fund. One is statutory Provident Fund, one is recognized Provident Fund, one is unrecognized Provident Fund, and public Provident Fund. But the table you can see that I have included only three Provident Fund. One is statutory Provident Fund, second is recognized Provident Fund, and unrecognized Provident Fund. Already I have explained little bit about recognized Provident Fund and unrecognized Provident Fund. So here you have to remember that statutory Provident Fund also we are including. And I told you sometimes you will get the theory question right about the types of partnership. So public Provident Fund is there that I have explained after this comparative table, because we cannot compare public Provident Fund with this. This is not easy to compare. So I have included only three Provident Funds for comparison. So first point is statutory Provident Fund. You can see that for government and semi-government employees. So government and anyone working for government organization or semi-government organization, they will be joining the statutory Provident Fund. The statutory meaning, then you know the name of the term meaning also. Statutory meaning it's compulsory. They cannot escape that because they have to compulsorily join that Provident Fund. See, I am a government employee, but I am getting my pension. Whereas bank employees, you know that they went for strike for getting pension or Provident Fund. So they have that option. So some employees have opted for Provident Fund, some employees have opted for pension. So you have to remember that it's statutory. If you're working for a government organization or semi-government organization, it's compulsorily created by the government because this will accumulate the savings of the employee. So whenever there is a need, they can use of the savings. It's compulsory savings. That is also needed. Sometimes if somebody is falling sick or hospitalization, anything like that, we need the money. So that is why statutory Provident Fund. Next point is recognized Provident Fund. Recognized Provident Fund, it is in the private sector. And unrecognized Provident Fund also is in the private sector. Now I told you the last module when I explained what is URPF, what is transferred balance. I told you transferred balance is important for 2-mark question. And recognized Provident Fund also I have explained. Once again I will tell you that when a private company is starting that business organization, if they want to give the employees the Provident Fund protection, what they will do, they will start an unrecognized Provident Fund. But you know the concept of Provident Fund. Employer will be contributing certain amount, employee will be contributing certain amount. This will get accumulated, and that will be the accumulated savings of the employee. So whenever there is a need, they can take loan. All these benefits you will see in the slide. So here they start as unrecognized Provident Fund. That's why it's mentioned in the private sector. Now they will try for income tax commissioner's approval. Then that unrecognized Provident Fund will come as recognized Provident Fund. So whatever is accumulated in unrecognized Provident Fund, when they will get the income tax commissioner's approval, they will transfer it to recognized Provident Fund account. That amount what they are transferring from unrecognized Provident Fund to recognized Provident Fund is called the transferred balance. Last module also I told you it's important for 2 marks and most of the students will get the wrong answer. So SPF is for government sector, RPF and URPF for the private sector. Now you have to remember whether they got recognition or not. Recognition from income tax department. SPF, it's by the government, definitely there will be approval or consent or recognition. RPF also, from URPF, when it's converted into recognized provident fund, there is always recognition is there. But unrecognized provident fund, I already told you there is no recognition. They are just starting that. Then they are waiting for income tax commissioner's approval. So there is no recognition. So that is the difference. Next point is employee's contribution. See, I told you employee will be contributing certain amount, employer will be contributing certain amount. So employee's contribution fully qualifies for deduction under section 80C. Now what is 80C? You have to learn deductions from gross total income. You know that what is gross total income now? Taking the total of 5 heads of income. 5 heads of income are income from salary, income from house property, income from business or profession, income from capital gain, and income from other sources. So that all that when you will add, you will get the gross total income. Now you have to remember, from gross total income, income tax department is giving us certain allowances for reducing our tax liability. The one important section is 80C. You are going to learn this in detail in the chapter deductions from salary or deductions from the gross total income. So that time I will explain clearly. Now you remember that this is an added attraction. The employees can get some tax exemption by reducing the amount they contributed to recognized provident fund from the gross total income. They can reduce that. Next point, recognized provident fund fully qualifies for deduction under section 80C. So this statutory provident fund and recognized provident fund 80C, they are eligible for claiming the deduction. Whereas unrecognized provident fund, there is no exemption available because I told you it's not recognized by the income tax department. They are waiting for recognition from income tax department. So now continuing with that, employer's contribution. So you have to remember that employer's contribution. So I told you employee will be contributing certain amount, employer also will be contributing certain amount. So in the case of statutory provident fund, employer's contribution will be fully exempted from income tax. So in the problem, sometimes they will give employer has contributed 14% or 15% or 16%. That amount we will not take for computation. When we will do the problems, I will again make it clear. Now, recognized provident fund, you have to remember that excess of employer's contribution about 12% of salary. See, this point is very, very important. That is what I told you. One or two points I am going to tell you that is very, very important. So, for recognized provident fund, see, in the last example, I have used that employer is contributing. Imagine employer is contributing 14% for statutory provident fund. Without any limit, it's completely exempted. Whereas for recognized provident fund, if the employer is contributing more than 12%, it will be taxable. Imagine employer is contributing 14% of employee's salary. So 2% will be taxable. So we will calculate that extra 2% and that will be added to the employee's salary computation. When we will do the problem, I will explain that. Similarly, interest credited above 9.5% will be taxable. So these are the 2 points I will tell you. This RPF computation, when you have to do salary problem, this 12% and 9.5% for interest. This you have to remember. Always this adjustment will be there in the calculation of salary income. So 12% I have explained. Now in the problem, sometimes they will get that RPF interest, the employee got 11%. That meaning 9.5% is only accepted. 11% is 1.5% is taxable because employee is getting 11% as interest for RPF, meaning 1.5% will be taxable. Now unrecognized provident fund, you just ignore that. We are not bothered about that treatment. It's not recognized. They will not get any tax exemption. Next one is interest credited to accumulated balance. Interest credited to accumulated balance, in the case of statutory provident fund, it's fully exempted because it's provided by the government. Whereas recognized provident fund, already I have explained in the previous point, above 9.5% will be taxable. So I told you if it's 12%, if the employee is getting 12%, that meaning 2.5% of interest will be taxable. That we will add with the salary income. So RPF contribution, excess of 12% by employer's contribution and interest credited above 9.5% will be taxable. These are the two important points you have to remember when you are doing the salary computation. Similarly, you have to remember statutory provident fund, it is exempted. Employer's contribution and employee's contribution and interest credited will be exempted. So this you have to remember. Unrecognized provident fund, there is no recognition. We are just ignoring that point. Now, refund or transferred balance of URPF to RPF. Now, I already explained what is transferred balance when amount is transferred from unrecognized provident fund to recognized provident fund. From unrecognized provident fund, if the transferred balance is to statutory provident fund, it is fully exempted. Now, whereas RPF, recognized provident fund, you have to see the condition, exempted in all cases except when the employee leaves service on his own before completing 5 years of service. Then the amount which is not taxed is added to salary income. See, in the case of RPF, recognized provident fund, see, sometimes employees will leave the job. Maybe they will get a better offer, they will go to some government sector job, they will go to a foreign country. It can be any reason. So you have to remember that all other cases it's exempted. But if the employee has not worked for 5 years, when the employee leaves on his own before completing 5 years of service, if an employee has not completed 5 years of service in an organization, that will be taxed, that will be added to salary income. Next point, URPF, exempted in all cases except when the employee leaves service of his own before completing 5 years of service. Amount which is not taxed is added to salary income. Same treatment for unrecognized provident fund and recognized provident fund. Now, we are coming to public provident fund. See, when you are getting a question, what are the types of provident fund? I have seen that students are making one mistake. See, there are 4 types of provident fund. Again and again I am explaining statutory provident fund, recognized provident fund and unrecognized provident fund. See, public provident fund is not able to compare with the other 3 provident funds. It's a totally different concept. That is why it's not included in the table. Table has only 3 explanations. But provident funds, there are 4 types. This you have to listen properly. Public provident fund also you have to explain if you get a theory question. Now you have to remember, this is started on 1st July 1968, Public Provident Fund. The term public, that meaning anybody can join. And who can join? This is meant for self-employed people, those who are running business unit, those who are doing consultancy, those who are any other. See, statutory provident fund is for government employees. Recognized provident fund and unrecognized provident fund, they are in the private sector. But if a self-employed doctor or a lawyer or a consultant, anybody, if they want to do a provident fund, because provident fund has got lot of tax exemptions. So if you want to make use of that provident fund exemption, where you will join? You can join with the public provident fund. So here also public provident fund, you will get the tax exemption under section 80C. 80C is the most beneficial section. You can reduce your tax liability. I'll just tell you, up to 1,50,000 you can claim the exemption. So that can be different investments. One will be our LIC contribution, housing loan repayment, the principal amount, children's education expenses, this provident fund contribution, like group insurance. So many items are there. So totally you can make 1,50,000. Imagine my salary, gross salary is 20 lakhs. When I am calculating gross total income, it's coming to 20 lakhs. Every year, I will take the exemption of 1,50,000 in 80C deduction. That meaning my gross salary 20 lakhs will be reduced by 1,50,000. Now my taxable salary will be 18 lakhs 50,000. 1,50,000 I can reduce my tax liability. So that is the advantage of making investments in 80C. Schemes which are eligible and they are giving me deduction under section 80C. So this provident fund is an example. So you have to remember that public provident fund, anybody can join. Though they are not working with an employer, if they are self-employed, they can join this and they can make use of this tax benefit. Now where they can open this? Account can be opened with SBI. Now you know that with the merger and all, SBI has got branches everywhere. So if you want to go and join, you can join an account with the SBI for public provident fund. Now annual subscriptions can be between 500 to rupees 1,50,000. So you have to remember that 1 year minimum 500 rupees you have to deposit in that account, and the maximum it can be 1,50,000. Now you have to remember 1 deposit per month is allowed. One deposit only for month is allowed. How much ever you want to invest, how much ever you can save, that will be the limit. You can decide that. But you have to remember next point, deposits can be in multiples of rupees 50, 50, 100, 150, 200, like that, any amount. 1 year, at least 500 rupees you have to invest, and the maximum can go up to 1,50,000. And many people are making use of that. Now, first withdrawal is possible after 15 years. So this you have to remember, first withdrawal they are allowing after 15 years. Now there are certain exceptions. Before 15 years if you are taking, it will attract the income tax. So that is why withdrawal 15 years there is a lock-in period that they have to keep it there for 15 years. Next point you have to remember, in case of death of the subscriber, full repayment is made to the nominee. So when you join the public provident fund, they will ask for nomination. You know that it's with the bank. Now with the KYC norms and all, they will ask for nominee. Without that, nobody can operate the account. So if the father is starting that, or if parents are starting that, they can keep their children as their nominee, or whoever mentioned as the nominee. Sometimes if husband is starting the account, wife is the nominee, or wife is starting the account, husband is the nominee. So whoever beneficial to get that, in case of death of the employee before this 15 years lock-in period, then the nominee will get the full amount. Next is partial withdrawal and loans are possible before maturity. That you have to remember that now they are allowing this partial withdrawal and loans. Partial withdrawal from 3 years they are allowing. From 3 years. If you have deposited that in the amount in public provident fund, but you are in need of money, what you will do? So this you have to remember that after 3 years you can start partial withdrawal. But there will be penal interest and all that you have to pay. Next, loans are possible before maturity. After completing 7 years of payment for public provident fund, you can start taking loans. So you know that salaried employees always they depend on loans. Maybe LIC loan, housing loan, vehicle loan. See, when they need for children's education or marriage or anything like that, if public provident fund is there, after 7 years, they can go and take the loan from that. Then repayment will be there, penal interest will be there, that and all the customer has to pay that. Now, interest credited this account is fully exempted from tax. So, it's very, very important. In the case of statutory provident fund and public provident fund, interest credited to this account is fully exempted from tax. Whereas in the case of RPF, I told you, above 9.5% interest credited will be taxed. Employer's contribution above 12% will be taxed. These are the two important points you have to take that for the computation of salary. Next point is public provident fund contributions are not liable to attachment by any court. This is a very important feature. See, for example, a person declaring himself as insolvent or bankrupt. Say for example Vijay Mallya or Nirav Modi or Anil Ambani. They all declared themselves as bankrupt. They are not able to repay the loan what they have taken from the bank. So if they have got a public provident fund account, any other asset they have, it can be attached by the court. You can see that they've taken the bank account, or they have frozen the account of these people because they have defaulted the payment. It like that, important people it will come in the news. Otherwise, for ordinary people, it will be happening every now and then. We will not get media attention, but it will be happening. So if these people who are famous people, those who declared as bankrupt, Vijay Mallya, Nirav Modi or Anil Ambani, anybody, if they got a public fund public provident fund contribution account with SBI, it cannot be attached by the court. That money belongs to them. So that is a very, very important point. So this is the main feature. Public provident fund contributions cannot be attached by the court. All other investments, if you have a vehicle, if you have a car, if you have a land, any valuables, it can be attached by the court, but not the public provident fund contribution. So this is the small module where I want to explain about the types of provident fund. So this module just the theoretical concepts, and 2 points you have to take it for computing the income tax problems. One is statutory provident fund. Employer's contribution is exempted, employee's contribution is exempted, interest credited is exempted. Recognized provident fund, 2 points very, very important. Employer's contribution above 12% is taxed. Interest credited above 9.5% is taxed. If I am taking face-to-face class, I will keep the students repeat this. So these points they should remember. Public provident fund, it is not possible for any attachment by the court. And interest credited is fully exempted like statutory provident fund. So I hope that the explanation about public provident fund statutory provident fund, recognized provident fund, and unrecognized provident fund is clear to you now. I told you one section 2 question, transferred balance, is very, very important. Some questions I have seen that they will ask you to expand the terms URPF, recognize RPF, SPF, PPF. Sometimes students may make mistakes in that also. So always remember that you have to learn the expansion properly, clearly. So this is what I want to explain about Provident Fund. And next module will be the computation we are starting. So computation of gratuity, I am going to take it as the next module. So one by one I will take that. So that is how I have planned my modules and I'll be uploading that. Thank you. Give me your feedback and suggestions so that I can improve.